Today we talk about mortgage risks and underwriting standards. Hello again, I'm Martin North, the Principal of Digital Finance Analytics. Three important developments to discuss today. First, the US 10-year bond has moved above 3%. Here is the latest chart. This is further evidence of the continued rise in rates in the USA as the Fed executes its plan to reverse quantitative easing and to take rates higher. This follows through to higher mortgage rates in the US, as shown by this chart. And this will have consequences as the capital market rates will follow, putting more pressure on the local banks here, who still fund significant portions of their books from overseas. And this will continue to put pressure on the BBSW, and it is likely to translate into higher mortgage rates ahead. Next, UBS has continued their forensic dissection of the mortgage industry with the release of their analysis of data from Westpac, which the lender provided to the Royal Commission. This was representative data from the bank of 420 Westpac mortgages, which were analysed by PricewaterhouseCoopers as part of APRA's recent review. APRA Chairman Wayne Byers found Westpac to be a significant outlier, with PwC finding 8 out of 10 mortgage control objectives ineffective. UBS says for the first time information on borrowers' total debt-to-income ratios, not loan-to-income, has been made available. They found Westpac's median debt-to-income was 5.4 times, with 35% of the sample having a debt-to-income ratio of above 7 times. Furthermore, 46% of mortgage applicants had an assessed net income surplus of less than $250 a week. This data raises questions regarding the quality of Westpac's $400 billion mortgage book, and 70% of its loans, of course. While Westpac has undertaken significant work to improve its mortgage underwriting standards over the last 12 months, UBS expect it and the other majors to further sharpen underwriting standards given the Royal Commission's concerns with responsible lending. This could potentially lead to a sharp reduction in credit availability. And this raises two questions. First, how much tighter will credit availability now be ahead? And we continue to expect an absolute fall in loan volumes, and this will be translated to lower home prices. Second, is this endemic to the industry, or is Westpac really an outlier? From our data, we see similar patterns elsewhere, so that is why we continue to believe that we have systemic issues. Income is being overstated and expenses understated. And customers have multiple loans across institutions, and these are not always being detected, so their total debt burden is higher than the bank sees. Combined, these are significant and enduring risks. Chickens will come home to roost, especially if rates rise. In fact, UBS has put a sell recommendation on Westpac. And finally, APRA, the banking regulator, has announced plans to remove the investor loan growth benchmark and replace it with more permanent measures to strengthen lending standards. This could be seen as an easing strategy to allow banks to lend more freely, but I don't think it is. In fact, it underscores the tighter lending standards now being imposed. APRA says the 10% benchmark on investor loan growth was a temporary measure introduced in 2014 as part of a range of actions to reduce higher risk lending and improve practices. In recent years, they said, authorised deposit-taking institutions have taken steps to improve the quality of lending, raise standards and increase capital resilience. APRA has written to the ADIs to advise that it is now prepared to remove the investor growth benchmark, where the board of an ADI is able to provide assurance on the strength of their lending standards. And in summary, for the 10% benchmark to no longer apply, boards will be expected to confirm that first, lending has been below the investor loan growth benchmark for at least the past 6 months, that lending policies met APRA's guidance on serviceability, and lending practices will be strengthened where necessary. And they say, as with previous housing-related measures, this approach has been taken in close consultation with the other members of the Council of Financial Regulators. With risks in the environment remaining heightened, It will, they say, be important for ADIs to maintain prudent standards and close any remaining gaps in lending practices. APRA Chairman Wayne Byers said that while the announcement today reflects improvements that ADIs have made to lending standards, there is more to do to strengthen the assessment of borrower expenses and existing debt commitments, and the oversight of lending outside of policy. Mr. Byers said the temporary benchmark on investor loan growth has served its purpose. Lending growth has moderated, standards have been lifted, and oversight has improved. However, the environment remains one of heightened risk, and there are still some practices that need to be further strengthened. So APRA is therefore seeking assurances from ADI boards that they will maintain a firm grip on the prudence of both policies and practices. For ADIs that do not provide the required commitments to APRA, the investor loan growth benchmark will continue to apply. And as part of these measures, APRA also expects ADIs to develop internal portfolio limits on the proportion of new lending at very high debt-to-income levels and policy limits on maximum debt-to-income levels for individual borrowers. This provides, they say, a simple backstop to complement the more complex and detailed serviceability calculation for individual borrowers and takes into account the total borrowings of an applicant rather than just the specific loan being applied for. Now, it's worth remembering that the Bank of England imposed limits on high loan-to-income ratios a couple of years ago to cool the market in the UK. So, in a sense, APRA is belatedly following suit, having argued previously that everything in the mortgage garden was rosy. What a change of tune. In the current environment, APRA supervisors will continue to closely monitor any changes in lending standards, and the benchmark on interest-only lending will also continue to apply, APRA said. APRA will consider the need for further changes to its approach as conditions evolve, in consultation with the other members of the Council of Financial Regulators. So now, standing back, combined, these three factors underscore that credit growth will continue to slow and the price of loans will rise, and there will be an intense focus on credit underwriting. If you want arguments as to why home prices will continue to drift lower and perhaps fall faster, you need look no further. If you like what you've seen here today, please like the post and add a comment or a question. I read them all. If you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And I want to thank those who have already subscribed. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.